Julian Emanuel of Evercore suggesting the bull market has room to run, writing the SpaceX IPO is not an endpoint. Like the AOL Time Warner merger in Y2K, it's a data point on the way to higher prices. Julian joins us now for more. Julian, good morning.
Good morning.
It's hard for people to internalise, given the move we've seen off the low, that maybe the FOMO and the melt-up is ahead of us and not behind us. Do you think it's ahead of us?
It has begun. But actually, if you look at the last 5 days and the sort of buttoning up of sentiment and the caution that we've seen, again, in these last 5 days, I would say that the true FOMO, the wild-eyed, buy at any cost, whatever it is, I'll take it, is still potentially ahead of us. But if you think about it, though, the market is really digesting all of this pretty well. Think about the headlines that we're dealing with this morning. We had strikes overnight. We've got the premier AI company talking about price wars. We've got the marquee software company that is dealing with CapEx issues. All of that negative, and yet the stock market is incredibly resilient in front of really a landmark moment.
Well, let's sit on the third point: the signs of fragility, the pushback to Oracle, the pushback to Supermicro, the pushback to Meta. That's adding up, is it not?
Look, and I think we've said this in past, it's become a market where it's not actually even billions anymore, it's trillions that we're talking about. And yeah, 85 billion here, 75 billion there. It really does add up, but it also speaks to the incredible liquidity conditions that we're seeing. And in fact, and part of the reason that despite the geopolitical disturbances of the last several months is that the economy came into this incredibly resilient. And what did we find out last Friday? The labor market is a lot stronger than we could have ever imagined it would be.
Do bond and stock investors want to keep paying for something that customers don't even want to pay for? I mean, ultimately, isn't that the message coming from OpenAI? That people don't want to pay the prices that are being charged, even though that's what's being financed essentially in bond and stock markets.
So there's certainly a pushback to there's a pushback to every aspect of inflation in our environment right now, whether it's, token prices or cattle prices or gasoline prices. But I think when we look at how AI has progressed over these last several years, the Jevons paradox seems to continue to be operative. If token prices come down, which there's every indication that they will, you're probably going to get increased usage.
Is it telling to you that we've seen this bout of volatility really come along with yields being the highest relative to the earnings yield in the S&P 500, a relative metric going back to 2003? I mean, essentially, bonds are offering a more attractive proposition as yields go up and as some of the valuations go up, and you see this relationship kind of become a little bit more even.
Well, and actually, it's a rational response, right? If you look at classical finance theory, the point is long duration assets, high value assets, like technology stocks, should be more sensitive to higher yields. And that's what we're seeing. But ultimately, when you look at past episodes of structural bull markets like the one that we're in, compared to, let's say, the internet in the late 1990s, or frankly, Japan in the late 1980s, you had a tolerance for higher yields as long as the economy was continuing to move forward, and confidence, which has been lacking on the consumer side, even though there's been spend, remains stalwart.
Can we talk about the consumer side for a second? The Washington Post has a story out this morning that oil executives are going to the White House and saying they're concerned that gas prices are going to rise. What happens when we hit $5 a gallon?
That for us is white knuckle time. We have made it clear that the work that we did around prior oil price spikes when the war started in March really showed that the window, given the strength that we came into at the war in terms of the economy and the strength that's remained, you've got about sort of 4 months and literally $4.50 or triple-digit WTI, the strains will start to show in the economy and likely the stock market, which again is why I think there's such a sense of urgency coming from Washington to figure out how to solve this.
No sense of urgency in the oil market right now, though, right? It's pretty impressive, isn't it? 92 on Brent, 89 on WTI.
It is quite impressive, and you know, I think perhaps speaks to the president's statement yesterday that we're able to get barrels out of the Strait one way or the another.
Julian, that's the tension right now. Oil market's telling you one thing, not much is happening because we're drawing down inventory so quickly and the executives are still on edge. And if you're in the equity market, you've heard it a million times over the last 3 months, you've started ignoring it. When do you have to start paying attention again?
I think really, again, we have sort of targeted the 4th of July as kind of a seminal date in things that are happening. If we are taking the same approach that we're talking about right now, you know, in an unmoving, hardening regime in Iran, and Washington, who really doesn't see how the end game evolves, that's likely going to further send the price of oil higher. And in our mind, that's the biggest threat, frankly, to the entirety of this bull market. It isn't the capital raising. It isn't the questions around CapEx. It's whether the economy can weather a persistent oil price shock. So far, it has, but...
There are two ways to look at this. On one hand, that more barrels are getting through the Strait of Hormuz than people realize, and that actually there is a leakage here that is easing some of the supply constraints. The second is that no one wants to trade oil because you're just going to get blown out. It is a very difficult move. Which is it?
It's both. It's absolutely...
Not helping Bramo this morning.
Well, no.
Julian.
No, think about it. A couple, you know, when the president first said that there were going to be further attacks, the price of oil went from down $3 to down $2.50. And I mean, it was like there was no pulse whatsoever.